without further ado, I want to introduce our featured speaker. He is an entrepreneur. He's a distinguished attorney here at Wilson Sonsini, one of the most prestigious law firms in Silicon Valley. He's a dynamic speaker and he's very passionate about helping entrepreneurs succeed. Let's hear it for Hans Kim.
Thank you for that introduction, Rob, and welcome to our offices. It's very nice to meet all of you, and we're going to speak today about early stage financing for startups. I am a corporate and securities attorney here at Wilson Sonsini. I've been working as a lawyer for about 20 years. I've actually been working longer as an entrepreneur. I've worked at 4 of my own startups. I've raised money for my startups and can really understand the position that you're in and empathize with your situation. A little background in terms of Wilson Sonsini. This law firm was formed in 1961. It was a handful of attorneys at that time, and this firm grew up with the Valley. Now to over 700 attorneys in 13 offices across the globe. Specializing in emerging growth companies, over 3,000 private clients, 300 public clients. If you've got legal issues, happy to speak with you after this presentation. One of the good things about this firm, even though we've grown so large, we're still dedicated to servicing early stage companies and entrepreneurs who are looking to get their idea off the ground. The topics that we're going to cover today include the current state of early stage financings, different structures to consider when you look to raise financing, the different instruments that you might use to raise your financing, including convertible securities, preferred stock. Then we're going to touch on important issues like dilution, and finally finish with crowdfunding. There will also be a question and answer period at the end, so please reserve your questions to the end of the session. Just to start out here, in terms of recent trends in 2016, we saw a real a spike in financings and in huge interest in startups in 2014 and 2015. The market was what we might think of as overheated a bit. In 2016, we've seen a little bit pullback on valuations. They're returning to reasonable levels. Early stage deal volume has decreased. Second, there's really an overhang of angel and seed companies. So what we're seeing, which is referred to in the trade press as Series A crunch, is that these firms that are unable to raise, are unable to gain traction, have difficulty raising their Series A financing. And so we'll touch upon that in this presentation. Just to back up these trends, I have a couple slides here on the recent data here in 2016. We've seen a drop off in first financings in 2016. We have this chart showing how firms that have raised early stage financing are now having difficulty in raising the post-seed money. So we're seeing a decrease, and you can see it's a pretty dramatic increase from prior years. And this chart shows the drop-off in early stage companies that are graduating to Series A companies. So obviously, all these downtrends, I don't mean to spook you or scare you to thinking that the environment's terrible, but let me clarify. So we're at a point where I consider the Valley to be really a tale of two valleys. It's never been easier to raise financing for a startup, and it has never been more difficult to raise financing for a startup. So how can both of those be true? So if you are a serial entrepreneur, you've got connections, you're coming out, you're one of the executives coming out of a company like Google or Facebook or LinkedIn. It has never been easier to raise money. There's a whole infrastructure here in the Valley and growing across the world to finance early stage companies. So if you are an experienced entrepreneur, or if you have a company that is gaining traction, there's a whole system here, and there's a lot of money out there that's willing to back you. On the flip side is, if you are an inexperienced entrepreneur and you have ideas, you don't really have traction, and you're going out to third parties who you don't have an existing relationship with, and you're trying to raise money, you're having a very difficult time right now to raise money because there's so many other startup companies that are looking to raise money. You really have to prove your case. So either you have a great idea, that they believe in you as an entrepreneur, and these investors are willing to back you, or you're having a very difficult time. So in terms of, what does this mean in terms of your financing strategy? There are 2 points here that I want to make. First of all, make sure you have enough money to get traction to raise a Series A financing, or have a plan to raise additional financing to get there. Because if you're going to build a product and you don't get to that traction point, you may face a difficult time getting the Series A financing. So just think about that. There's a lot of companies, and we're talking about this overhang, a lot of early stage companies that are raising money, and they're running out of money, they're trying to raise money, they don't have traction, so they're facing that prospect. Consider that your Series A financing might be the 4th round of financing these days. You've got friends and family round, you might have a pre-seed or accelerator round, and you've got seed angel rounds, and finally, when your product is showing some traction, you get to Series A. The second point here is succeed or fail quickly. So we see, again, a lot of companies, if they get traction quickly, they're able to raise financing. If you're not getting traction and you continue to pump money into the company, one of the most difficult things that we face in advising clients is when they run out of money and they're really having a difficult time raising additional capital, and that's just a tough scenario to deal with. So just consider that as you plan out your financing strategy. This chart shows the financing ecosystem. It's developed in the past 5-10 years. It's a lot different than it looked previously. You've got your angel incubators and accelerators who are financing early stage companies. You've got your pre-seed round with super angels and other micro VCs. And the pre-seed is the new seed, and the seed these days, what we refer to as seed, is really the new Series A. And this is why, as you go down this chart, and you pitch yourself to the venture capitalists, they're looking at all these companies coming through this funnel, and you need to be able to be one of those companies that really stands out from the crowd of startups that are pitching to these VCs. In terms of accelerators, and I have this chart just to show some of the accelerators that are in the ecosystem. They really are playing an important part, an important role in early stage financing. You've got Y Combinator that has almost 1,300 companies since 2005, 1,500 companies and counting in 500 startups, over 100 companies to AngelPad. This is only a fraction of the accelerators that are out there that are funding startups, just a small fraction. And so you have to consider, as you raise financing, there's just a lot of companies out there that are getting early stage funding and will be looking to raise Series A. So now turning to the different legal structures and financing structures that you might consider for your startup. You've got common stock, debt, convertible securities series, and preferred stock. So these are the main types of instruments or securities that you would consider to issue for an early stage company. I've highlighted convertible securities because that's probably the most common form of early stage financing these days for early stage startups. But let's go over the pros and cons of each one of these types of financing. Common stock is usually not preferred by investors because it has no liquidation preference. So usually investors, they want to come in, if they're going to invest in stock, they're going to want preferred stock, which has a liquidation preference, which basically means that they get their money back first. They're not going to put money into a company that's early stage and have to share that value with all the common stockholders. They're going to want some protection, usually. The second structuring issue when you issue common stock is if you're an early stage company, you've just issued common stock to your founders at par value, which might be a fraction of a dollar, a fraction of a penny to the founders, and you turn around and at the same time issue common stock at a high valuation to investors, that could potentially cause some tax issues for the founders. It also impacts what's called the 409A valuation of the common stock, which is the valuation that's used to set your exercise price for stock options in the company. And usually companies want to keep that exercise price as low as possible in order to compensate their employees with stock options that have a low exercise price so that the employees can gain in the value of the company as it grows. Second is debt. So investors typically don't invest debt in early stage companies because there's no upside, right? So what investor is going to want to invest in a startup if they only get a simple interest rate? So it's usually not a good form of structure to use to finance your startup. Now, if you have investors who, including the founders, who want to put money into the company, there's nothing wrong with that. You can have founders put in money under promissory notes and use debt as a way to finance the company, but you might want to consider whether that debt might convert into a convertible security when you issue it to other investors, or it might convert into preferred stock when you actually do a financing round. The third instrument here is convertible securities, and we'll get into detail on the different instruments in convertible securities. And the last two are forms of preferred stock that get issued to investors. A note here at the bottom is that you really should limit your investors to only accredited investors. Under the securities laws, there are ways to issue these securities to unaccredited investors, but there are greater disclosure requirements, and life is too short to deal with unaccredited investors. You want to deal with people who know what they're doing with their money, or have the financial wherewithal to finance your company, and also it's a lot simpler process in finding the proper securities exemption to issue those securities. Second point here is that there are a lot of finders out there who will tell you, I can find you investors, just give me a percentage of what you raise, or give me a percentage of the stock that you issue. And unless that finder is a registered broker-dealer, that is not a legal transaction under the federal securities law. So you really want to be careful about using finders to find you money. And you should talk to your corporate attorneys or securities attorneys if you have any of those issues. Convertible securities. So convertible securities has become really the most common form of early stage financing instrument. And this timeline shows you the evolution of this instrument. I think it's helpful to see where this instrument came from. Back in around 2007, we started seeing startups using convertible notes as a type of bridge instrument to fund startups to get them to the Series A. And when I say bridge instrument, the convertible notes were actually used to bridge financings between preferred stock financing rounds. So between a Series A and a Series B, they might use a convertible note that would convert into the next round of financing, maybe at a discount with some interest rates. It was really a quick way to finance a company. And it started getting adopted by startups saying, well, if we use it between a Series A and a Series B, why can't we use it for a startup to finance the company to get to the Series A? So it started to get traction in 2007. In 2010, Ted Wang introduced Series C. So he basically developed a set of documents that was a really simple form of preferred stock financing documents and proposed that as a good way to finance early stage companies so that you didn't have to deal with all the complicated documentation that's included in a Series A set of documents. In 2012, as convertible notes started to gain this traction, Founder Institute and Wilson Sonsini looked at this instrument and they noticed that a number of these convertible notes were reaching their maturity date and were not being paid back and they weren't converting into shares, and you had these debt instruments on these startups' balance sheets that were really default obligations of these startups. And so they asked the question, well, why do we need to have an interest rate and a maturity date in these instruments? Those are features of a debt instrument, and they don't really align with the expectation of the investors. Early stage investors they're not investing for an interest rate, right? They're not looking to put the company into bankruptcy if they don't pay on the maturity date, which was set at like a year or 2 years out. So they proposed, we need to take out the maturity date, we need to take out the interest rate, and that's where convertible security came out. And that was starting to get widely adopted. And then Y Combinator came out with their version of convertible security called a SAFE instrument. And then in 2014, 500 startups came out with their version called the KISS, which they built in a number of investor protections. We're going to go in detail over each of these instruments. Again, convertible notes, the key features here are they do have an interest rate and a maturity date. It converts into preferred stock upon a qualified financing. The key provisions here are the discount and the valuation cap. When we talk about a discount, this is generally between 10 and 30% discount to what the preferred stock pays in the financing. We're really seeing most of our convertible instruments come up with about a 20% discount. So that's really the norm these days. So to deviate from 20% discount on a convertible note, there's probably usually some reason to deviate from 20% discount. In terms of valuation cap, investors, when they saw this, yeah, discount is nice, but what if your preferred stock, your first preferred stock financing is at a very, very high valuation? So you can imagine that the investor put in money, they're going to get a discount to the price paid by the Series A investors, but what if the Series A is put off because the company's doing so well in the first financing rounds at $100 million valuation? Well, getting a 20% discount to a $100 million valuation means you're paying an $80 million valuation. Yet you finance the company in an early stage when it started. So that's not really a good return for the investor. who bore that early stage risk. So that's where valuation cap comes into play. So the valuation cap basically says investor is not going to pay over that valuation in their finance. So if the valuation cap, for example, is $5 million and you invest $1 million in the early stage financing convertible security, the highest price that you will pay is a $5 million valuation, so you'll get 1/6 of the equity of the company. You're not going to get your $1 million be turned into equity at a very, very high valuation. The other negotiable terms include liquidation overhang, and I'll explain more about that. Sometimes investors negotiate a sale of company premium. They might negotiate what's called most favored nations clause, which means that if you issue securities with better terms, then I have an option to get those better terms. And then preemptive rights, which is basically I get investment rights into your future financing rounds, which is actually a very important term for investors who are looking to maximize their returns on companies that are doing well. So as I said earlier, convertible security basically stripped out the interest rate and maturity date. It's pretty much convertible note without those terms. Again, this type of security, since there's no maturity date, there's no awkward situation where you hit the maturity date and the investors have the ability to put the company into bankruptcy. Y Combinator's form of convertible security is called a SAFE, Simple Agreement for Future Equity. It converts into shadow preferred stock to avoid extra liquidation preference, and I'll go into this liquidation overhang issue shortly. It has pro rata rights agreement for future financing, and there are 4 versions that are on the Y Combinator website. One that has cap and no discount, one that has a discount and no cap, one that has cap and discount. Again, as I said earlier, I think the fairest form of instrument actually is a cap and discount. Really ensures the investor they get a better deal than other investors in the Series A. It gives the investor some extra return from bearing that early stage risk. 500 startups looked at the SAFE instrument and they said, well, it's really too company favorable. So they came up with their own version of a convertible security that pushed back on certain things. They thought that this instrument would be more balanced. It actually built in the change of control premium. So if the company is sold, the investor can get 2x their money. It has a most favored nation provision built in, and it includes major investment rights. But in terms of the convertible securities, I think the SAFE has really gained the most traction in the last couple of years. It's a very simple form of document. Those forms of documents are on the Y Combinator website. People pull them out all the time. It's pretty much the instrument that I recommend to my startup companies to use. The form is there. When you negotiate with investors on that document, you can say, hey, it's on the Y Combinator website. Here it is. We fill in those 2 numbers, we're done. I mean, so one of the main advantages of convertible securities is it's quick, it's easy. If you use a SAFE document, it's only got those 2 numbers, the discount and the valuation cap to add in, and investors cutting you a check. The one pushback that investors have done with SAFEs is asking for side letters. So they realize that SAFEs don't have all these investor protections built in. So some of the more sophisticated investors will ask for a side letter, which says, yeah, you could be issuing all those SAFEs to all your investors, but I'm special. I need a side letter that gives me certain added protections. And so you may find yourself negotiating with certain investors. especially professional investors, who will ask for certain rights in what's called a side letter. It's a letter that is outside the instrument, and it's a special deal that's cut with that investor. It might include information rights, financials, things like that, provide investment rights. Professional investors are very concerned about having the ability to add on to their investment, because once they realize that your company is a winner, they're going to want to keep putting money into your company, because that's really part of their maximization of their return, is being able to continue to invest in the winners. Most favored nation, board observer, protective provisions, those are some of the things that you might see in the side letter. Liquidation overhang. So what is this? So the issue here is that if you give the same type of preferred stock to the investors who are converting at a discount, then you're actually giving them additional liquidation preference. So let me give you an example. If the Series A price is $1 and the conversion price is 50 cents per share that's given to the safe holders, then there's an additional 50 cents of liquidation preference that you would be giving to those investors. If they get the exact same type of preferred stock. You've got $1 per share liquidation preference, but you're getting twice the number of shares of stock as a safe investor, so you're getting 2x your money. So there are two ways to deal with that. First is you can convert the amount into preferred stock at the Series A price and pay the extra shares in common stock. Common stock doesn't have a liquidation preference. So you're keeping the liquidation preference equal to the amount that the investor invested. The second way is to set up what's called a shadow series of preferred stock. So you might see something called a Series A1, a Series A2, a Series A3 type of stock. Each one of those series has a different per share liquidation preference. Different amount of money that gets paid back to that investor upon a liquidation. So those are the two ways. Now, sometimes investors will say, I don't want either of these. I want that liquidation overhang. So this is something that you do negotiate with investors. Sometimes investors will say, no, don't put that in. Part of my extra return as an early stage investor is to get the liquidation overhang. But I think it's important that you realize this as you raise financing, that you raise this issue and that you're aware of this issue so that you're able to negotiate it. And certainly the SAFE instrument deals with it with shadow preferred stock. And so if you use a SAFE instrument, then you don't have to worry about this issue. But if you use old forms of convertible notes, certain types of convertible securities that doesn't deal with this issue, you should look into this. Preferred stock financing. So a question that I often get asked is, should I use a convertible security or should I issue preferred stock? Some of the advantages for convertible security are it's simpler, faster, and cheaper. So when we do SAFE instruments, we can just do that in a day. You get that form, you put in the two numbers, you get a board consent, investor's writing a check. Pretty simple. And we're doing SAFE instruments for increasingly large amounts of money. We've had SAFE financings for millions of dollars. Why preferred stock? Well, you might consider preferred stock if you've set the valuation. If you already know what the valuation is, if you've agreed on a valuation with your investor, you might consider actually doing preferred stock. It avoids this issue of discount to the next round of financing. You've got greater certainty. You know exactly what your dilution is going to be. You might avoid worse economics with the convertible instrument. And that's something you really need to understand when you raise money is what are the dilutive effects of your instruments. And we do have some slides at the end about dilution. There are certain advantages also to the investor. They may prefer stock because they get certain tax advantages. QSBS, which is qualified small business stock, gives them certain tax advantages. You avoid issues with maturity date, like we talked about before, and some investors refuse to invest in those types of securities. If you are going to raise money with issuing preferred stock in your early stage company, you're usually not going to go with a full set of Series A financing documents. A full set of Series A financing documents are 5 heavily negotiated, very detailed set of documents. And so if you're early stage, really recommend that you look at seriesc.com. These are a set of documents that are really meant to, again, give the investor a liquidation preference and avoid most of the complicated provisions that you would see in a full set of Series A documents. No anti-dilution, no registration rights, there's no voting agreement, no co-sale, no legal opinion. There are certain provisions that are in those set of documents, including the potential for the Series C investor to appoint a director. But it is a much simpler form of preferred stock document, and it will keep your legal costs lower. The point at the bottom here about beware of fake Series C. If an investor says, let's do a Series Seed round, as the company you should say, hey, let's just use the seriesc.com documents. It's been standardized, let's avoid the negotiation, let's avoid increasing our legal fees. So just use that standard set, you'll get your liquidation preference, maybe you'll get a board seat, but again, you don't want to negotiate a full set. In terms of the full set, these are the documents that you would see in a full set of Series A documents: an amended and restated certificate of incorporation, a stock purchase agreement, investor rights agreement, right of first refusal and co-sale agreement, voting agreement. I won't go into detail. I think it's beyond the topics we're going to speak today, but there's plenty of information on the web, and you can speak to your attorney if you're at that stage. Certainly, you need to get competent legal counsel if you're going to negotiate those provisions. Just in terms of what are the provisions that you should focus on in a Series A financing, include obviously valuation, the liquidation preference. So when I talk about liquidation preference, it's not just the ability for the investor to get their money back, but what are the terms that they get it back? So there are different types of liquidation preference. So some investors might say, I get 2x my money back, or I get to participate with the common stock in the proceeds after I get my money back. There are different types of liquidation preference that you need to consider. Board seats, protected provisions, founders vesting and acceleration. Again, those are things you can have fun with negotiating when you get a term sheet, if you're fortunate enough to get to that stage. Dilution. So I've got some charts here just to show what happens with dilution. So initial capitalization, you might have two founders, Ted and Bill, each get 45%, get an option plan. So that's kind of what the cap table looks like at outset. You might get an angel round, says they want 10% of the company, with one of the different types of financing instruments we talked about. You get the Series A coming in for 25%. Angel, that 10% is fixed because the convertible securities, they convert over at the valuation cap, so they get fixed 10%. And the option plan, it gets increased because the Series A investors want you to increase your preferred stock, your stock option plan. So by the time you get to a Series A, you might face something like this. You can see that you get diluted pretty quickly. And you just really, the point here is you really should do the math. When you raise money on safes or convertible instruments, understand dilutive effects when you raise your money. Understand what the valuation cap is. Understand what happens with a discount. It's easy money. It's like so easy to put those two numbers and you sign, you get the check, you often running to the races. But then you realize, well, what did I do, right? I mean, so understand that. Understand when you plan out your financing, what's the optimal time to raise money? How much do you need to get how far, right? So I need this amount to get me to this milestone, my valuation will go up 10x. You need to think about that. And if once you figure out your financing needs as a company, and every company is different, then you'll be able to figure out maybe an optimal strategy in terms of when to raise financing. So again, avoiding early stage dilution, looking for raising money at a much higher valuation. Having said that, I don't want to discourage you from raising as much money as you can, because obviously the startup game is a very, very risky proposition. So you got to weigh those two. But at least you're giving it some thought. You got a lot of entrepreneurs who don't really understand the dilutive effects, and they get into this situation. By the time they get to Series A, they've lost control of the company. The investors are all asking for board seats. Now you've got the loss of control. Last point we're going to talk about is crowdfunding. When we talk about crowdfunding, there are two types of crowdfunding. One, which is called rewards-based crowdfunding. This is not selling of securities. This is basically pre-sale of your product. And we've seen a large growth in these sites like Kickstarter, Indiegogo, GoFundMe. Lots of companies are raising money through their campaigns. It's great. If you have a product that you can make a really snazzy video, get out there and excite your consumers and say, hey, you need to buy this product. That's great. It's an excellent way to raise money without diluting your equity. It might not be such a good deal for the people who are buying your product, but hey, they love your product. So and we've seen some spectacular blow-ups. If you've been reading the papers, a company called Scully, the motorcycle helmet, they just blew up recently. They had pre-sold a number of motorcycle helmets. So you got to understand what obligations you have as a company to deliver product that you promised to deliver on these sites. But there are different types of obligations. These are not securities types of obligations. When Oculus Rift pre-sold their headsets, and then it was announced that Facebook was acquiring the company, all these consumers who had pre-bought the headsets were saying, well, where's my return? Am I going to get 200x the money I put in? You saw these people on the blog saying, oh, no, all I get is a headset. That's all you get, right? So I think there's going to be a little more attention being paid to this part of financing companies, because there should be additional protections for these consumers, because a lot of consumers are getting a short end of the stick if the companies can't produce the product. So we'll probably see a little more attention being paid to that part of fundraising. Second part is actually equity crowdfunding. And this is an emerging set of laws. It's interesting. It doesn't impact us as much. There are certain things that we look at for early stage financings that you might consider. Syndicate funding, for example, through Angel List or Funders Club. So Angel List, you can set up a syndicate. So if you have a lead angel who's willing to lead a round to finance your startup, you might consider having a syndicate on Angel List and getting that group of investors, all accredited investors, to invest in your company. There's 506C now allows you to advertise, to generally solicit for selling your securities. But you really have to understand that if you do a 506C raise and you're doing a general solicitation, you're obligating the company to actually do a much deeper dive into the accredited investor status of the investors. So you're going to have to ask for tax returns or a statement from the accountant or bank account statement. So that's generally something that we like to avoid, because which investors like to give up their tax returns, right? Certainly Donald Trump doesn't want to do that. So generally I recommend to avoid that. Regulation A plus, mini IPO, that's something to consider in specific circumstances. The issue there is that it costs a lot of money. There's a lot of legal costs and other administration costs to do the regulation A plus, mini IPO type filing, but it does make sense for certain types of companies. And most recently, regulation crowdfunding through portals allows there to be crowdfunding through these certain types of portals. But it is subject to many limitations. So generally, don't think that that will gain traction. Obviously, this is an emerging body of law, and we'll probably see additional changes to the laws, hopefully to make it easier, and as well make it more protective for investors, but hopefully make it more easier for startups to raise financing from qualified investors. So that's the end of my presentation. Thank you for your time. So now we have a question and answer period. And if you have a question, there are some microphones set up.
All right, so my question's along these lines. One of your slides you mentioned, don't work with non-accredited advisors to help you raise funds. So what if you're new to Silicon Valley, you're not well connected, you didn't work at Facebook or Google, you need to raise funds? How do you find people if you don't have that network all in place? And second part of that question is, what does Wilson Sonsini do in regards to introductions to angels and things along those lines?
Okay, very good questions. First of all, in terms of using finders to find money. So my point there is basically don't hire these so-called finders and pay them a percentage of the proceeds. So some of these individuals or companies maybe are putting themselves out as saying, I can raise you money from these investors, let's sign a contract that obligates the company to pay a percentage of the proceeds to me. Okay? So that's something that you need to avoid. On the other hand, if you hire an advisor or consultant to help you with fundraising and give them some shares that is as compensation, maybe you give them a stock option or restricted stock, or you pay them a salary, that's okay. Second question in terms of Wilson Sonsini helping make introductions. Yes, law firms should do that. We do that where it makes sense. Obviously, every client who comes in and says, I want to meet all of your contacts. We can't do that, but we're happy to when it makes sense. And that's a discussion that you should have with your attorney.
I want to make sure I got it right. You're talking about donor funding like an MVP. I think you said promissory note, or was that a...
Yes.
Okay, so can you touch on that a little bit?
Sure. So the question is about early financing, like maybe at outset, you basically just incorporated the company, and the founders put money into the company. So we see that situation a lot. A lot of times it's not documented. They'll pay legal fees out of their own pocket. They'll cut their own personal checks. They'll even pay the rent out of their own checkbook. So what do you do with that? What does that mean? So anything that's spent on behalf of the company for the company's benefit, that's a reimbursable expense. Right? So technically, it's if you have that expense, you can submit a reimbursement request to the company, and then they can pay you back. So really, it's sort of an advance on it, it's really an advance payment on behalf of the company. Now, how do you document that? Well, you could potentially document those expenditures through a promissory note. Maybe it's a one-page document that says, company owes you this amount of money plus X% interest rate. Simple form of interest. That's the simplest form of document. It's like a one-page document that says that's what they owe you, right? So, and then when it comes time, when the company has the money to be able to pay you back, they pay you back that money plus the interest. And so that's really the simplest form of financing. And obviously, all the founders, that's what they do to finance it. They don't always document it as promissory notes. They may just submit a reimbursement form, and you work with your accountant to do this and your bookkeeper to do this, and you get paid back out of the company. It's the same. It's really the same thing. The promissory note is actually formal documentation that adds an interest rate feature to it. Yes?
Hi, can you comment on the impact
brand name or tier one investors on subsequent rounds of funding, and how important that it would be to get those guys early, and how you would weigh that against each other.
Okay, so the question is, in terms of who you take money from, what's the value to take money from brand name investors, say maybe a well-known venture capital firm? So, so that's a complicated question. It depends on the circumstances. But if a brand name VC wants to cut you a check for early stage financing, I'd say pretty much that's a pretty, that's something you absolutely have to consider. Because if they're cutting you that early stage check, they see something in you, and they have the deep pocketbook to be able to fund you in subsequent rounds. And since Silicon Valley, a lot of it's run on relationships, that's a great relationship to have. So yes. The second point is that not every money that you take from investors is equal. Some money that you take from intelligent investors will add value in so many other ways, not just their money, but through their contacts, through their knowledge of your space, through their ability to help you find other companies or founders to work with. Those can be even actually much more valuable than the check that they write to you.
So much for your presentation. I went to US and China investment forum today, and I saw a lot of Chinese investors are interested in investing in US dollars. So how do you think about it? What should entrepreneurs be careful about raising money from those Chinese investors?
So the question is, what should you consider when raising money from Chinese or other foreign investors? So to add on to the point about not all money is equal, right? But if you can get money at a very high valuation from some foreign investor who's willing to fund you, sometimes that's a pretty good deal. I represent a lot of companies that actually do get very, very good financing terms from foreign investors. Because there are certain investors who are flush with cash and want to get into the space, and they may have other strategic reasons to make the investment. So again, once you get the money, you got to understand what that means. Again, obviously you have to weigh the alternatives to your financing. If you're saying, well, should I take it from a Chinese investor or should I take it from this VC? Again, going back to my answer to the earlier question, if the smart money adds value in other ways, and certainly Chinese investors can add a lot of value in their ways too. Maybe it's, hey, we're interested in investing in you because the market in China is X times larger than the market in the US, and we're going to help you to grow your business in China. And I've got clients who that's the situation, and that's actually a very, very attractive thing, especially because you may have a limited team that's really focusing on US market, and you need to have partners in overseas markets to help you grow globally. Yes?
I have a follow-up to that one.
Sure.
So what about, there's been some scare tactics out there, but okay, China's great, but there's dirty money in China. So it's connected to the government, things like that. What again, as a relatively new startup, how do you go about doing the due diligence process, or is that where your legal representation comes in, or what do you recommend there when you're dealing with people overseas who don't necessarily have all the credentials all in line that AngelList and other people here in the States?
Okay, so the question is, well, should you be concerned about some of the maybe bad reputation, or there's certain maybe illegal activities being conducted by some potentially that you may think that's happening with the investor. Should that be considered? Absolutely. So you should know your investors, right? You should know who you're taking money from. You should know what again is attached to that. Also, under the securities laws, there's what's called a bad actor on the securities laws, and you need to avoid taking money from bad actors because they can impact your ability to raise financings. You should talk to your lawyer about specifics about bad actor issues. Okay, so if I understand your question correctly, it's like when the timing of taking money.
Yeah.
So, and I think I touched upon this in my presentation, is that every company should look at when they need money and avoid the dilution, right? So I think that's one of the things that you really need to figure out is how much dilution am I getting? Because again, there are certain companies that can raise a lot amount of money early on at a low valuation. And you may not want that. You may not want to take all that money all at the earliest stage. So you may want to think about taking some of it now and really delaying and taking additional monies until you have a higher valuation.
Thank you, Mr. Han, for giving a great presentation. I have a question regarding to one of the slides. You have basically the option for employees. If we can give stock option, let's say, to certain users, would that fall to that category also? Or would that give, because those users might make contributions to that?
Okay, so the question is, and this is an interesting question, is there ability to give stock options or other equity to users of the product as opposed to employees? Is that's really your question? So whenever you issue securities, you need to find the proper federal and state exemption, which means that it's exempt from registration under the securities laws. So stock options and equity to employees falls under particular exemptions that we're all familiar with. Now, issuances to a group of users, you're going to have to talk to your attorney about your particular facts in terms of what these users are providing, if there's some type of service relationship with the company, rather than just being a user of the product. So again, that's something that is really fact specific.
So if they are a service provider, let's say they provide some sort of service to the company, then that would be okay under going forward to the employee.
Yeah. So if you got a stock option plan, is really designed to give stock options and restricted stock to service providers. Includes consultants or employees, or it could be a user of the product who's actually advising you on the development of the product, and you have some type of service relationship with them. You can actually grant them stock options under that plan as well. But again, you got to talk to your lawyer about specific facts in your case. Right? You can't just call them service providers and issue them equity. Yes.
What's your experience in seeing the value of getting funding or
Okay, so the question is, how does the value of IP impact the ability to raise financing? And so we're in Silicon Valley. IP is critical, right? It's the thing that the lawyers and the investors diligence. They need to make sure that the intellectual property is solid, that the company owns the IP, that you have particular protections. So, and it's really company specific. So if you're a medical device company and you have a patent, obviously that is the value of your company, right? That is the ability of that medical device company to prevent others from copying your invention is incredibly valuable. That's what is afforded under the laws. On the other hand, if you're a software company, you have some ideas and they're not really protected, then the issues are going to be more, well, where's the value? How, as an investor, if I'm going to invest in your company, how can I know that somebody, a better engineer, can basically make a better product overnight? That's called sort of barriers to entry that they will look at in terms of your financing. So those are the kind of things you need to consider as you develop your pitch to professional investors for your financing.
Okay, the next question. This might sound a little bit high-tech.
Mainly.
That's okay, high tech, you know, you're in the right place. So,
The cryptocurrencies are a hot issue in recent years. So, like in Silicon Valley, you have the first venture capitalist fund in bitcoins. I think from 2012, 2013, something in that area. But more important, more thought is so-called currency Ethereum, which managed to create collect over $160 million for its first type of venture capitalist fund, which was called DAO. That's like an acronym for Distributed Autonomous Organization, which acts like an automatic venture capitalist fund. And all the stakeholders, like investors, use principles of liquid democracy to vote upon the projects to be funded. What is your opinion, basically, about the future role of cryptocurrencies when it comes to funding for startups?
wow. I will have to say this is a first. And this is great. I love the question.
I'd love to, if you told people about the option.
Yes. So the question is, what do I think about cryptocurrency in financing startups? And honestly, I have not given a lot of thought. But now that you've raised it, you know, if maybe we can discuss after in terms of the details about what the issues are, because I personally don't have the background in cryptocurrency to be able to give a good answer on that.
I mean, the Jobs Act that you mentioned plays a significant role in this area.
Well, if you're talking about cryptocurrency in terms of raising money from persons who we don't know the identity of, then we've got an issue. Okay? Definitely have an issue, and you should talk to your lawyer about that. Okay? So most of the financings that we do under the securities laws, right, fall under a certain exemption that depends upon your accredited investor status, right? And if you're not accredited, then you've got other laws to deal with. But we've got other issues now in terms of identification of investors and how important is that. And those are specific issues that again, is beyond my knowledge base. Happy to talk to you after to talk through the issues.
Okay, thanks.
Sure.
Since I'm still standing here, that means I have another question.
Sure.
There is just one, I'm going to share the information too. In UK, since the takeover of government by Cameron, they made this scheme that people that pay high level of taxes can divert that part of those taxes paid and become an investor in a startup. I'm not so much more than just this, what I just said, but it's something that's worth wading in.
Where is this? I'm sorry.
In UK.
In UK. Okay. So I'm not familiar with UK laws. So you're going to have to talk to a UK attorney about that. But it doesn't surprise me that governments are joining sort of this and trying to make it easier for startups to raise money. And certainly having tax deferrals and things like that is an important consideration. Certainly under US tax laws, we do have certain laws like QSBS, which is Qualified Small Business Stock Rules, that can give tax advantages to investing in startups. And certainly that's something that everybody should look at to maximize their return.
Thank you, and love it.
Yeah. Oh, thank you. Thank you very much.
I have recently met traditional bankers who show up at trade shows and banking conferences who offer funding on a loan basis, taking collaterals against existing company assets. These are usually mature startups that already have assets in terms of hardware, IP, and these banks are offering single-digit interest rates are flexible. And in some cases, it could be quick money, easy money, maybe a bridge between series or a stopgap for against inflation. What's your take? What are the pros and cons for going down this route? Thank you.
So the question is on venture debt. So taking money from professional lenders who will lend you money at a certain interest rate, but yet that debt is secured against the company's assets. So very common form of financing for more mature companies that have assets that banks get comfortable lending against. And basically it's secured. So you got to understand the notion of the bank has a security interest in your assets. Basically means that if you don't pay back the bank, then they can foreclose on your assets. So they can take away your assets. That's a security interest. It's just like if you have a mortgage on your home, right? So it's a common form of financing, and it's a lot of companies actually put those in place. They work with like Silicon Valley Bank or other of these other banks that do this venture sort of financing, this venture debt financing, and that's fine. But again, every company's different, has different circumstances, whether, hey, does it make sense for me to take bank lending, or does it make sense for me to actually raise another financing round? So you kind of weigh those two. Sometimes these companies that are backed by, especially top VCs, the VCs will recommend, why don't you open up a bank line so that this can help with short-term liquidity issues. You know, you got that 1 million, 2 million in the bank financing, it's open to you. You don't have to take the debt, but it's available to you in case of a shortfall in cash because maybe a major customer doesn't pay their bill on time and you need to pay the payroll. So it can be very useful to have that. The bank will generally charge an interest rate, and they'll also ask for a warrant or some other type of equity kicker, and you'll see that. That's typical in a bank debt financing.
So you were mentioning earlier incubators and accelerators, all the options that are out there. So if we start looking for that, aren't necessarily looking for $500,000 or $1 million hits, but they want to just kind of downgrade straight away. How do they choose what options are out there? What things should they consider?
Okay, good question. So question is on accelerators and incubators and how what a company should consider in terms of which accelerator to go with. We do get asked that question, but a lot of times it's you as an entrepreneur who needs to figure out which one of these accelerators or incubators really matches what you're trying to do as a company and who has the best connections, who's able to provide the resources and advisors to help you grow. So the relationship with these accelerators, like a Y Combinator or 500 Startups or an Angel Pad, just doesn't come with money. It comes with a program sometimes and a class that you're mingling with other founders of companies. It comes with a set of advisors who are going to help you to grow. Frankly, that can be just as valuable as the money, as I've said earlier. So it's really up to you to kind of do that due diligence to figure out who's the best for your situation. In terms of the economic deal, that's the other thing. In terms of economic deal that these accelerators ask for, a lot of them are pretty similar. Usually it's like 7% of your equity will give you between $100,000, maybe a little more, right? $120,000. So they're usually pretty similar. Some are giving worse deals. So you consider that as well as some of the benefits that you get out of being in the program.
Yeah, actually, quick follow into that.
And just one final note is that when you come out of like a Y Combinator or 500 Startups, you got the demo day and you've got the badge. It's really a branding thing now. Those accelerators are so well known that when you come out and you're saying you're a Y Combinator company, that does give you additional sort of street cred, right? When you actually go pitch yourself to investors, you've actually gotten to that stage and gone through the program.
One quick follow-on is, I know for Y Combinator, even 1 through 20,
Yes.
it's about 5 to 9%, something like that.
7%, yeah.
It's about 2 to 4 years ago, they, it's not Y Combinator, but some of the incubators on Santa Monica, actually on the lab, I know the guy,
So the question is, the terms for the early stage financing from the accelerators are changing. They're actually becoming more favorable to companies. And I think that's just a response to maybe some of the competition in the market. I think all of these accelerators look at what the terms are offered for the other programs, and they need to adjust their numbers to make sure that they're able to attract the best companies to their program. I mean, it is a two-way street in terms of being admitted to the program, but also that they have just as big an incentive to get you into the program and get their equity, right? Which sometimes is incredibly valuable. I mean, I think Y Combinator has a number of huge unicorn wins, and it's exciting. It's really exciting, but again, they need to keep that going, so they need to be competitive with their financing terms. Sure.
So you just mentioned warrants. Can you talk about how warrants impact dilution?
Warrants.
Yes.
Okay, so the question is, how do warrants impact dilution? So generally, a warrant is a type of security that says the investor can get a certain number of shares at a certain price, right? So does it impact dilution? Absolutely. The investor has that option. If they give you a certain amount of cash, they can get that equity. So in a fully diluted basis, you need to count all of those shares under the warrant under your cap table.
I've got a couple of questions. First one is a very basic one. Is it okay to try to raise money if you have zero customers, or you don't have a product or maybe a prototype or anything? The second question is more about software development. Is it the norm to open source your software? Is that a good thing from an IP standpoint? You could argue that you have established quite a lot by opening up your software, or it could also hurt you because there's more of those better engineers that could copy your work.
Okay.
Whether it's your
Okay, thank you. So two questions here. One is, can you raise money without having customers? Let me tell you, most of my startups raise money without having customers. So absolutely, absolutely. And that's most of these companies. How else are they going to be able to develop their prototype or get to the next stage? Is yes. So no problem there. Absolutely. Second question is, what should I do with my software? Should I make it open source? Do I need to keep it proprietary? That is a strategic business question depending upon your software and how it fits in the marketplace. There may be open source type strategies that get your software widely disseminated, and you may have sort of the ability to make money with an open source strategy. But that's something that I think is really particular to each software company.
I have a question in conjunction with the warrant.
Mm-hmm.
So do you usually give percentage or do you do it on shares?
So the question is on a warrant, do you give a percentage or a number of shares? And typically we like to see a fixed number of shares in a warrant, right? That says, but there's nothing to prevent, say, the warrant is exercisable for X% of the company at a certain point in the company. You just have to be careful and work with your lawyer on the definitions to make sure that it works and it matches what the business agreement is in terms of what that percentage is of. But when you say a percentage of a company, what does that mean, right? You got to figure out what the denominator is, right? You got to figure out what is fully diluted. And so that's something that all of these instruments, or at least most of them, have to deal with. You got to figure out, well, what does that mean, fully diluted? Does it include the issued shares? Does it include the full stock option plan, including issued options and reserved options that have not been granted? Does it include warrants? Does it include, and certainly when we do these convertible securities financings, one of the issues that you negotiate with preferred stock investors is, well, how do we account for the convertible securities and all those shares that have been issued upon conversion of the convertible securities? So you've raised, say you've raised a couple $100,000 or safe, and now that's going to translate into 10% of the company, and you've agreed on a valuation of the company of $10 million. Do all those shares, are they counted in the pre-money valuation? Typically, if you've spent all the money, then that should count in the pre-money cap table, right? So all those shares that get issued to those investors, even though they're converting into your preferred stock financing, that's already spent money. So all those shares go into, it dilutes all the people before the financing. That's the kind of math that you got to do when looking at dilution. Yeah.
Hey, I want to have your insights about startups coming from outside countries.
Yes.
Probably like when you are looking for financing, so which advice you can give? What stage of their startup?
So thank you for that question. The question is about what should an overseas startup think about when they come into the U.S. to raise financing? It may be a company or it may be an individual who's overseas and they want to come work in the United States and develop their company. That is a question that we get all the time. And there's a lot of issues that you need to consider as an overseas person or company in coming to the U.S. The first thing I want to say is that there's this impression of foreigners who come to Silicon Valley. They may not be just foreigners, but foreigners in terms of outside Silicon Valley. So the person might be from New Jersey, where I grew up. So they come to Silicon Valley and they think, there's so much money out here. Everybody's getting funded. I read in the paper about all these people making billions of dollars. I'm going to do that. I'm going to come here. I'm going to raise my financing. Everybody's cutting checks. All I have to do is move to Silicon Valley, and people are going to be writing me checks left and right. No, don't put that out of your mind. I got a lot of companies from Asia and Korea, where I'm from, and they've got great technology, but they think all they need to do is move here, and people will be writing them checks. That's not true. Okay, so you really need to figure that out. Come here, do your homework, figure out whether it makes sense to move your company. A lot of times they have existing operations overseas, so technically there might be issues in terms of taxation issues to move a corporation to the U.S. Once you move a company to the U.S., you're subject to U.S. taxes. There may be taxable effects in terms of doing a conversion to a Delaware corporation. All our companies are Delaware. But those are things that you really need to consider. Second of all, immigration issues. So you really have to consider your ability to work in the United States. And if you don't have the proper work authorization, then you got to ask yourself the question, well, how am I going to get that? There's some companies that are trying to solve this problem, but you really need to think about that. Some of these foreigners are here on H-1B visas, working for another company, and that H-1B is particular to that company. You can't work for other companies. So we see that issue all the time. You need to figure that out with a good immigration lawyer, so that you can figure out the plan forward to get your company off the ground. But I guess the message here for foreigners is understand what you're getting yourself into. Don't think that just because you move here, you're going to take off and be, even though you've got great technology, you're going to fit right into Silicon Valley. You just have to do your homework first.
Do you recommend analyzing the process to choose lawyers?
Choose lawyers. Okay, so the question is, what do you need to do about choosing lawyers? And I think that's a good question. That's something that's near to me. So as an entrepreneur, I think you need to look at a couple things. Okay, first of all, find a law firm that is startup friendly, that understands startups. So there's a lot of law firms that don't really have the right mindset for startups. Certainly a firm that's willing to defer fees maybe and work with a startup in terms of when the fees get paid is very helpful. And most importantly is that relationship with the attorney, who the attorney is, and maybe what connections they have, how much they understand your business, the issues that your business faces. Again, I do think it's very important to actually do the homework, meet with a lot of attorneys and figure out what's the best match, who gives you the best deal, who who understands how things are done. I will tell you that Silicon Valley lawyers here, we do have a particular brand type of financing. It's not, I mean, obviously, these documents, that they're known throughout the country and even in foreign countries. But in terms of expertise, a lot of it is here. In terms of cutting edge, these things like safes. Like I was on the phone about, and it's been around for a couple years, but I was on the phone 6 months ago with somebody, a big law firm on the East Coast, and they had never heard of it. And I was like, okay. But it just goes to show you that things move so quickly here in Silicon Valley that it's really advantageous to be with the people who are at the edge in terms of innovating product. And we certainly do that here at Wilson Sonsini. We're always thinking about coming up with a better safe, for example, right? Safe's not the end of it. We're going to see further innovation in legal instrumentation for startups. I can guarantee you that.
Thank you, Hans.
Sure.
I have a question regarding friends and family who are investing. How do you determine what percentage you give them and how much money that equates to at the beginning? Or do you determine that after the fact? And what kind of instrument do you give them at the beginning, or just verbal? How is that done?
Okay, so that's a good question, and that's something that a lot of entrepreneurs, that they get money from friends and family, and they're like, well, how do I figure out how much to give them? They're not writing me a check because they're negotiating this investment. They're writing me a check because they're my mother, or they're my brother, right? They just want to help me out, right? I need money. What do I do? What do I give them? What's fair, right? So now I got to get to valuation. Oh my goodness. My company's worth $10 million. Give me a little money here. So give me a little love. So, so that's a hard question. The safest thing to do with friends and family these days, we have these instruments now, right? We have the safes. You can agree on a valuation cap, say early money, you convert over at a discount, 20% of what the professional investors pay at the preferred stock financing. Maybe you set the valuation cap pretty generously. Maybe you set it at 10 million, right? So it's pretty high. Maybe you're amenable to changing the terms, because these terms can be amended over time. So you set the valuation cap at 10 million for your friends and family, and then later you're selling it at $5 million valuation cap. You're like, I just, kind of screwed over my brother. I don't like that. So you're free to amend it. You're free to amend those terms to make them all consistent. But that's just something, that's a personal thing. That's really a business decision and a personal decision that you need to make. But certainly we have those instruments. So consider safe, convertible securities. It defers the valuation issue.
More questions for Hans? He's not billing.
Not yet, yeah.
Oh, let's hear it from Hans.
So I want to thank Hans for speaking to us tonight. Thank him by giving him the classic idea of the ideal coffee mug.
Thank you very much.
It's all late
So
nights.
it is what it is.
So Hans will stick around for one-on-one questions.